Hello everyone, welcome back to Investing Sucks. My name is Eric and thank you so much for tuning in. So today we're going to be doing a video on Suncor Energy, and the reason I wanted to do a video on Suncor specifically was because I've seen a lot of chatter recently about this company. You have a lot of people saying that potentially this company could be severely undervalued, and if oil continues to rebound like a lot of people expect that it will, when you have travel opening up and then oil demand increasing from the airplanes, then this company could potentially be a very good investment right now because it has been hammered quite a lot recently. But then on the other hand, you have some people saying that it's probably not as undervalued as some people seem to think, where if oil doesn't continue to rebound like people expect that it would, this company could take a pretty huge hit and it's not going to produce such good returns as a lot of people might expect. But on the other hand, you have some people pointing out that Suncor may potentially be a value trap, and you shouldn't just rely on data from recent years to point out how good of an investment Suncor could potentially be. And there are actually some valid causes for concern on why you wouldn't necessarily want to invest in a company like Suncor, despite the fact that if you just look at basic valuation metrics, they are actually pretty undervalued right now. So for one, you have increasing regulations and pressure from environmentalists, all putting pressure on Canada's oil sands operation, which actually is very heavy when it comes to emissions, just the way the oil gets extracted, produced, refined, and all that. But we can't be so naive to think is that oil is going away anytime soon. I mean, the Canadian economy especially relies very heavily on oil. It's a big part of our exports, it's a big part of our economy. And pretty much a lot of Western cities that kind of live in these oil sands areas, pretty much their entire economy is just based on the price of oil. So it is very important, and society as it is today is very dependent on oil. A lot of people like to think that the future is going to be in renewable energy, which obviously it is. We are going to have to get to a point somewhere in the distant future where our energy just comes from renewable sources, because eventually the oil will wear out, and yes, it is very emissions heavy, so it's not exactly great for the environment. But we're not there yet, right? We're still very, very reliant on oil, which means companies like Suncor aren't going to be going away anytime soon. Now, Suncor is a $38 billion company as of me recording this video, and in Q1 of 2021, they actually reported $821 million in net earnings, which if we prorate that total out across all of 2021 and then divide it by the current market cap, that gives a PE of about 11.5. So that's pretty good value, especially based on just the company that Suncor is, with the operations and how large and established they are. But it also seems that people have been calling Suncor undervalued for many years now, and their stock price really hasn't moved. So here on the screen I've pulled up a 5-year stock price history for Suncor, and yeah, as we can see, the stock price really hasn't moved. I mean, it's gone from, we can see around about $35 here, it's gotten up to about $45. Which is in, I guess that's around 2018, but really it's kind of been in the bull market for quite some time, and then obviously this drop here was just due to the crash in oil prices that we have. But people do have some concerns where if Suncor has been such an undervalued company for so long, why hasn't its stock price continued to go up or gone up at all? Why has it just really either remained rather stagnant or just taken a hit? So the goal of this video is going to be to determine how undervalued is Suncor really. So we're going to look at historical financial information, and then we're going to determine a valuation just solely based on the historical financial information. And also we want to determine what prices does oil need to be in order to earn a decent return on that, because that's really the main risk when it comes to Suncor, because as we know, their revenues, their cash flow, their earnings are all going to fluctuate significantly depending on whatever price oil ends up being at, which oil is very volatile, as we're going to look at in a second here. And when you invest in a company like Suncor, you're really making a bet on oil prices as well, because you're investing in the future earnings of an oil company, which obviously is going to depend on the price of oil. So this video will be a little different than my usual video. I'm not going to go in depth on a company background or talk about their growth prospects, just because I feel most people watching this video already have a pretty good idea of who Suncor is and what they do and all that stuff. So I don't really think it's useful for me to go over all that stuff. But anyways, without further ado, let's actually get into the video now, and we'll start by looking at oil prices. So here is about 70 years of oil price history, and as we can see, it's extremely volatile, right? The price is going to be influenced by many different supply side factors and demand side factors. So supply side factors could just be what OPEC decides to do, because OPEC, the countries that are in OPEC, control about 40% of the world's supply of oil. And also demand side, for example, air travel, which we touched on, which is something that I think a lot of people are expecting to pick up in the coming years once the economy begins to reopen. But if we look at more recent information, for example, from 2010 onwards, we can really just see a general downward trend in oil prices. It kind of peaked around this area up here, which was kind of in the 100 range for a while in kind of early 2010, but since then it's gone down quite a bit, and we can see an absolutely dismal year in 2020 where it pretty much crashed to about about $20 there. So we're probably going to see that reflected in Suncor's financial statements. We're going to see them have a pretty poor 2020 year just based on this alone. So yeah, as you can clearly tell, super volatile, which is kind of increases the risk of an investment like this just because you have no idea what oil prices are going to do into the future. Okay, so now let's actually look at Suncor's historical financial information. So I've compiled 8 years of historical financial data on things like cash flows, revenue, earnings, and all that. So we're going to look at that now and see what kind of trends we can identify. Okay, so here is 8 years of historical financial data. This is all in millions of Canadian dollars, and obviously it's for Suncor. So we're going to start with revenue, and we can see in 2013, I've also included the average oil price for each year down here. So we can see about $98, $93, and then it continues to go down as we just saw in the oil prices. So 49, 43, 51, 65, 55, and then 40. So 2020, as expected, was a pretty dismal year. And then the revenues will pretty much vary depending on the price of oil. So we can see the revenues were quite high in 2013 and 2014 when oil was almost at $100. And it did have very minimal revenue growth year to year over here. But then, as expected, once oil prices get sliced in half from where they were, the revenue goes down quite a bit. So when oil prices came down kind of in the 50, 60 range here, we can see their revenue really never got higher except for these 2 years here when oil rebounded a bit than what it was over here. So maybe revenue was just, oil prices were much lower than they were over here, but the revenue wasn't actually much lower. We can see 40 billion here and then only like 38, 39 billion, with oil prices being in the 50s and 60s range versus the almost 100s. So that proves that they are actually expanding their operations, which is a good sign. And then net income is going to be pretty much aligned with that. So net income fluctuates quite a lot, again, depending on oil prices. That's just expected. And then I've also included a return on invested capital here. And then as expected, that's just going to vary depending on whatever oil prices are at. So 2020, very dismal year, negative 6.1%. But if we look at these earlier years here, 2013, 2014, it was much higher. So then if we move down here to cash flows from operations, so cash flows from operations is based on net income. There are obviously adjustments that are made to that, but we also expect this to fluctuate depending on oil prices. So it was pretty strong here. They were investing a lot of their cash flow from operations back into CapEx, as we can see here. 10 billion in cash flow from operations, and then 6.8 billion went back into CapEx. Versus if we compare that to say 2019, where they had 10 billion cash flow from operations, only about 5.5 billion went back into CapEx. And then if we look at CapEx, the kind of the general trend, you can see 6 billion, about 7 billion, 6.6, 6.5, 6.5, and then it gets a lot lower here. So it looks like they are not investing as much in their CapEx as they were in previous years. So if they can continue to have strong cash flow from operations without having to invest as much back into CapEx, then their free cash flow is going to be pretty good. And then if we're calculating free cash flow to equity, which is the valuation method I want to use because that's what we care about as equity holders, is how much free cash flow we have available. Part of that formula is adding back any issuance of debt or repayment of debt that they have. So they issued quite a lot of debt in 2020, which they had to, right? They had to fund a lot of losses. But before that, it was mainly paying down debt. So 530 million there, 174 million, $1.1 billion in debt repaid, $2.3 billion in debt repaid. So then the sum of all those three numbers up there will give us free cash flow to equity. So this fluctuates a lot. And I've included this down here, which is free cash flow to equity as a percentage of revenue, which is what we're going to use in our valuation model. And then the average over that period was about 6.4%, but it's much higher in more recent years. So 2018, 15%. So free cash flow to equity, 15% of revenue, and then 11% of revenue. And then it's 11% here, but that's primarily due to all the debt that they took out. So, and then I've also included down here free cash flow as a percentage of revenue, excluding the debt portion. So if we just want to look at the business, right, we don't want to have any influences on our free cash flow just based on what they decide to do with their capital structure, so issuing more debt, repaying debt, it's a lot more stable. And then we can see average over that 8-year span of just under 5%, but much higher in more recent years. So 7.5%, 13%, 12.5%, and then the dismal 2020 year of -5%. Okay, so moving down now, let's look at shares outstanding. So this was the weighted average shares outstanding for each year. So 2013 all the way to 2020, not really much of a change. We can see it kind of went up, up, and up, and then around, it peaked around this area, and now it's going down. And I believe Suncor is actually buying back shares, so that's a good sign. When we do our valuation, we can project that shares outstanding will continue to decrease because that's probably what they're going to use some of their free cash flow for, which as equity investors is great because that increases our ownership in the company and makes our shares more valuable. And then we can look at free cash flow to equity per share, which is a very important metric. This is really what we're buying, right? Because if we invest in a company's equity, we want to know how much free cash flow they're generating on a per share basis. It's pretty much equally as important as earnings. And then if we compare this to the average share price, we get a free cash flow yield. Now, free cash flow yield is very important because this actually tells us what we can project the stock price will be in the future if we just project how much free cash flow per share they have, which is what I'm going to show you later. So free cash flow yield, we want to take that as an average over this whole time span, which is about 5.2%. So if you own a share in this company, in free cash flow, they're generating about 5.2% of the value of those shares. And then we can also look down here because they do pay dividends. Dividends are very important for anyone who's investing in this company. So let's look at how safe these dividends have historically been. So we have free cash flow, which is excluding the debt issuance and payments. So just kind of free cash flow as generated by the business, and then compare that to the total amount of cash dividends they paid out. So we want this to kind of be in the 20 or 30% range. We don't want it to be too high. For example, here, 759%. That means they didn't generate enough free cash flow to cover their dividend, which means in order to pay it, they probably had to issue debt. And then same thing here. It's negative because they actually had negative free cash flow, probably because they were putting a lot of their money back into CapEx. As we can see up here, 5.6 billion in cash flow from operations, 6.5 billion went back reinvested into CapEx. But a lot more stable in kind of these years here. This is really what you want to see. You don't want to see them paying too much of their dividends out. You want it to be a sustainable dividend that they could increase if they could. But here, as expected with that really bad 2020 year, they didn't have positive cash flows and they probably had to issue some debt, which as we can see up here, they did. They issued debt in order to pay those dividends. So you really want to see stable dividends. So hopefully in the future, their cash flow from operations can go up and they'll easily be able to pay it. So this is really the first company that we've looked at on this channel that has had financial statements that appear to be getting worse over time. Most of the time we've been focusing on these kind of high growth tech companies and utilities companies that appear to be doing pretty well, but with Suncor that's not the case. And we can clearly see a direct correlation between whatever the price of oil is and how well this company does. So if oil prices are high, Suncor is going to be a great investment, but if oil prices aren't as high as you want them to be, then you're not going to get as great a return on this, and they're probably going to have to issue debt in order to continue to make dividend payments and, you know, just kind of keep strong free cash flow in the business. But anyways, let's actually go into the valuation model now, and I'll show you what I did. I had to get pretty creative with this one, and we'll see what kind of a return we can expect from investing in Suncor. Now, what I will say about this valuation model is that I made it to be very conservative. So it is extremely conservative, which I think is an important thing to do, especially with a company that has risk as high as Suncor does, right? Because as we saw, oil prices are extremely volatile. That means more risk for us as investors because we don't know what's going to happen in the future, which means we want to have very conservative assumptions built into a valuation model, because as long as they just do better than those conservative assumptions, then anything beyond that is just upside for us. And it also, when you're doing valuations in general, it's good to keep things conservative because you want to leave room for upside. You don't want to build a valuation model that's only based on, you know, very optimistic growth projections for the company, because if they don't meet those optimistic growth projections, you're just faced with downside. So if you have very conservative projections and they're still a good investment with conservative projections, then you know you've got a pretty solid investment on your hands. So let's go to the model now. Okay, so here's the valuation model, this part here. I've got a few assumptions built into it here. And what I want to point out first is what I have up here, which is what I've called the revenue predictor, which I actually ran a linear regression formula. Now, for those of you who aren't math nerds, don't worry, I'm not a math nerd. This sounds a lot more complicated than it really is. Basically, all it did was look at the kind of price correlation between the oil price and the company's revenue. So, because as we saw clearly, the company's revenue will fluctuate depending on oil prices. There's no question, there's a positive correlation there. So what this formula did was take that historical financial information and then create a formula that will predict what revenue will be given what price of oil. So if we substitute the oil price for X in this formula, it actually predicts what revenue is going to be. So that's how I've projected revenue down here. And then the assumptions, so like I said, we're going to keep things very conservative. Oil price of $60. Now it's currently at, I think last time I checked, it was about 65, 70, somewhere around there. And from what we saw in the past, 60 was kind of in the middle, right? It's not super conservative, but it's not overly aggressive. And so basically anything that, or if oil goes higher than $60, that's just more upside that you would have in an investment like this. And then I assumed shares would be bought back 1% per year. So every year the company's going to buy back 1% of their shares. And then free cash flow to equity as a percentage of revenue, I assumed to be 7.07%, which is an average of the past 4 years. I didn't want to take an average of the past 8 years because as we saw, there was a downward trend in their CapEx spending. They're not investing as much into CapEx, which would increase their free cash flow to equity. So it made more sense to use more recent information there. So now I've got oil price at $60 each year from 2021 to 2027. Now I know what you're thinking. Obviously that is dumb. That makes no sense. Oil isn't going to stay at $60 per year, constantly for that whole time period. And you're right, it's not. We know that oil is going to be extremely volatile. And because it's going to be volatile, we can't possibly predict what it's going to be each year. So all we can do is say, okay, maybe over this 7-year time horizon, oil prices will average about $60 because that's kind of a conservative estimate given where they've been as we saw in recent years, right? Because if we go back to kind of the early 2020s, it was all the way up at 100, right? So because we want to make this model conservative, we're going to assume that it's just at $60 and it averages $60 for all those years. Obviously it's going to be, up and down throughout this whole time period, but to keep things simple, we'll assume $60. And then revenue, so if we plug $60 into this linear regression formula, we get revenue that's projected to be about $33.6 billion. And because oil prices aren't changing, it's going to be just one steady stream of revenue throughout that whole time period, which again, doesn't really make sense because it's going to fluctuate. But if we assume that 60 is the average, then revenue over this time period will average out to about $33.6 billion a year. Again, given conservative assumptions. Anything that's higher than that is just more upside for this. Now our free cash flow to equity, so I just assumed this would be, like I said, 7.07% of revenue. So that's all this number is. It's just 7.07% divided by this, which again is just going to be a steady stream of free cash flow to equity. So about $2.3 billion in free cash flow to equity per year. Again, some people are probably going to think that's conservative, but that's the goal of this model. And then shares outstanding. So this, like I said, is just going to decrease at 1% a year. So that's all it does here. Every year it goes down 1% until eventually it gets to about 1.4 billion shares outstanding. And then we can look at free cash flow to equity per share, which quite simply is just this number here, free cash flow to equity, divided by the shares outstanding. So this is going to be a gradual increase. And this is really what we're investing in, right? Because when you buy a company, you want to buy free cash flow. That's why you invest in companies like this. And like I said before, it's going to fluctuate a lot, but averaged out over the 7-year time period, we can assume it'll probably be around this. And that free cash flow to equity, they can dividend it out, which would be a return for us as equity holders, or they could just keep it in the business, which would make the shares more valuable anyways. But now let's take these assumptions and put them into an IRR calculator. Okay, so right here is our IRR calculator. We can see what I have here is kind of the cash that we put in versus the cash that we get out, and then whatever that transaction might be. So we're going to purchase the shares today for about $26 Canadian. Now, I don't keep up to date with the stock price that much. I mean, it could fluctuate a lot, but it's usually going to be around $26. That's kind of what it's been trading at recently. And then the free cash flow per share. Remember, this is what we get as we invest in the business. So they can dividend this stuff out. They can retain it in the business, which would make our shares more valuable. Either way, whatever they choose to do with this free cash flow is going to make our shares more valuable. So we can only assume that that is part of our cash inflow, right? So there's going to be It's about halfway through 2021 as of making this video, so we'll get half of the free cash flow for 2021, and then for 2022 all the way to 2027, as we projected what the free cash flow per share would be. That will be kind of a stream of income over the course of that holding period. And then what I did here to kind of determine what the price would be when we eventually sell the shares at the end of 2027, which I projected to be about $32.22 per share, I just took the most recent free cash flow per share and then divided it by the free cash flow yield. So the 8-year average of the free cash flow yield, which remember was calculated as free cash flow per share divided by share price. So if we kind of invert that calculation and we take free cash flow per share divided by the free cash flow yield, we get what the share price will be estimated to be at the end of 2027. So it's about 32.22, which I think is reasonable, right? Because when we looked at their stock price, they weren't going up and down that much. It was pretty stable. This could get to, say, $40 if oil prices go higher than we expected. Because remember, all these assumptions are based on $60 per barrel oil price over the course of the next 7 years. So anything higher than that is just more upside. So with that, we get an IRR estimate of about 7.4%, which I think is pretty solid given conservative assumptions. It's not necessarily a screaming deal. It's not the type of thing where you just want to drop everything you're doing and go remortgage your house and take out cash advances all to just invest in this company. But I think given how conservative we made our assumptions, that's a pretty good return on investment. Now, if we go down here to the sensitivity analysis, this actually changes what our IRR estimate will be given just different oil prices. And keep in mind, these are oil prices in terms of average oil prices, assuming they remain steady for the next 7 years, which, as we know, they're going to fluctuate, but let's just assume they remain steady, and over that time period they average about, whatever number we have here. So at $50 per barrel, 6.3% IRR estimate. If it goes up to 100, then it gets much more attractive, and it's about 11.5%. But keep in mind, this assumes all the other assumptions remain true. So their free cash flow as a percentage of revenue still is the same at about 7%, which really, if oil prices go to 100, it's probably going to be much higher than that. So really, this could only kind of be used to just gauge kind of what the risk is when it comes to oil prices, because really, if oil prices are in this range here, the stock price is probably going to raise pretty fast, and you could sell it at a much better gain than what this would indicate here. But this does kind of put their current valuation into perspective and allow us to kind of determine how much risk is inherent in a company like this, just dependent on whatever the price of oil ends up being. So back to the main question of this video now, is Suncor Energy a great deal or is it a value trap? Well, as we saw from the numbers, it's not necessarily a screaming deal, right? It's definitely interesting. It's worth looking into a bit more, just based on the numbers we did. If we take a very conservative oil price, they actually do get a pretty solid return. I mean, 7%, it isn't amazing, but it is pretty good, especially given our conservative assumptions. But is Suncor a value trap? I wouldn't necessarily categorize it as a value trap. So for those of you who don't know what a value trap is, it's basically when you take a company's recent financial performance, so the past, say, 5 years, and compare it to their current market cap, and then say, well, look, they appear to be severely underpriced just given their recent performance, but the reason they're underpriced is because there's something else that's going on in their industry or within the business that is causing investors to be worried. So a great example of this would be BlackBerry in the early 2010s. A lot of investors were fleeing BlackBerry stock because they were worried that with competition from Apple's iPhone that BlackBerry would lose market share and they'd become less valuable as a result. And investors were absolutely right to worry about that because that is exactly what ended up happening. And if you were to look at BlackBerry stock in that time period, you would have seen a company with strong earnings that's very underpriced relative to those earnings. But if you look at the way things actually panned out for BlackBerry, they're a lot less valuable of a company today than they were when they were actually selling phones, because they pretty much had to shift to just stop selling phones and only sell hardware or software now. So I wouldn't categorize Suncor as that because they are an energy company, right? And they produce oil. Oil isn't going anywhere. And as much as people like to think that the future is in renewable energy, we're just not there yet. And oil is going to be around for at least another 10 years, probably even more than that. And as we saw, if oil continues to rebound and say it can go up to $70 or $80 and average that price over the next 7 years, then yes, Suncor is going to be a great investment, but that's the risk you're taking on, because it's really important when you invest to kind of boil down the company you're looking at to just one or two key issues, right? And with Suncor, it's really one main issue, right? What does oil prices end up being, which you just don't know. So that's really what you can do as an investor. If you are encouraged by Suncor, you want to look into them a bit further, just say, okay, let's take conservative assumptions. Let's assume oil prices kind of stay pretty low compared to where they've historically been. What kind of a return we can get. And that was the goal of what I tried to do there. But maybe I'm wrong, maybe I missed something, maybe there's someone else who's watching this video that has a very different view on Suncor. I'm sure a lot of people have different views on Suncor. They are a very popular company that I think a lot of people like to look at. So if you do have an alternative view of Suncor, feel free to post it in the comments and start a discussion about that. I'd be happy to read over it. I'm always interested to know what people think of certain investments and if people have a different point of view than mine. It's always nice to learn about that. But yeah, anyways, that's pretty much does it for me, guys. So thank you so much for listening to the video. If you did enjoy the video and you found it useful, then please give it a like and subscribe to my channel if you are new to it. I have plenty more videos like this one planned, and I'll see you in the next one.